Hi, I hope you enjoy the following presentation. Please stay tuned at the end of this presentation for a special offer from FXCM and Pristine. Thank you. Hi, this is Ed Ponzi, the Chief Trading Instructor at Forex Capital Markets. I'm here today to talk to you about some Forex trading strategies. We're going to get into some very specific strategies and techniques for trading the Forex market. Now, we have a lot of ground to cover today, but before we get started, I want to make it to you very clear that Forex trading, like any other form of trading, can be risky and you can lose some or all of your funds. So that being said, I'm going to take a look at some of the advantages of FX. If you're not familiar with them, I just want to briefly go over these, and this way you'll be familiar with them and be able to take advantage of these advantages for technical traders. First of all, if you are a technical trader and you're using technical strategies in the equity market or perhaps the futures market, you're going to find that those type of techniques, for the most part, do translate over to the FX market. So you do not have to reinvent the wheel. You can use the same types of strategies that you're using now. Also, the Forex market lends itself to strong, persistent trends. Sometimes these trends go on for months or even years. So obviously, if you're a trend-following trader, that's going to be one aspect of the Forex markets that you're really going to like. In addition, this Forex market offers superior leverage. Leverage of 100 to 1 or 200 to 1 is very common. The barriers to entry are very low. You can open an account with just a couple of $100. So again, superior leverage is a very big advantage. And while we're talking about advantages, we need to mention that this is a market that has tremendous liquidity. We're talking about the equivalent of $1.4 trillion per day in liquidity. Now, that's going to be a great deal more than any other markets that you may be involved in, any equities markets or futures markets. And in addition, you really don't have to worry about your order disrupting the market. Unlike, for example, illiquid stocks. If you go into an illiquid stock and place a sizable order, you're going to completely disrupt the market. Whereas it would take, you'd have to be an extremely large trader, a hedge fund, a bank, a multinational corporation, or a very large individual trader to actually, do anything to move this market. In addition, Forex, there's no directional bias. It's just as easy to sell short as it is to go long. There's no uptick rule. And there are no bull or bear markets per se. The reason for this is because you're trading two currencies. You're trading one currency against another. So because there are two entities involved, if one is weak, then the other is strong in relation to it. So if one currency is in a bear market, the other one will be in a bull market in relation to it. And in addition to that, we're talking about a market that follows the sun around the world. It is a seamless 24-hour market. So instead of having your schedule conform to the market can conform to your schedule. So it's much more convenient in that sense. Now, if you're a fundamentally based trader, if you trade based on fundamentals and fundamental strategies, there are also some big advantages available. First of all, the information is going to be readily available to you for the entities that you're trading. For example, if I'm trading a stock, perhaps a smaller liquid stock again in this case, it might be very difficult to track down that fundamental information. I might have to sift through some databases, and and of course you need to obtain that in a timely manner. But if we're trading Forex, we're not trading individual stocks. We're trading entire economies, entire countries. So it's much bigger than any type of trading of individual stocks, and therefore information is much easier to acquire. In addition, we do not have really fraudulent accounting issues in the Forex market, especially I'm sure you're aware of the equities markets and the problems that they've had with opaque accounting procedures or just basically made up accounting procedures. And again, that's not going to be an issue because we're not trading individual stocks, we're trading entire economies here. And it's also considerably less complicated. I mean, I do not have to sift through thousands of stocks to try to find the right candidates to trade. Instead, I can just look through a handful of economies. I only need to follow the economies of a handful of countries, and then I have the information that I need. One huge advantage, if you're the type of trader who likes to trade news events, if you like to trade economic indicators, this is going to be a tremendous opportunity for you because if you're an equity trader, for example, a lot of economic indicators may be released before the stock market actually opens, and you will not have the opportunity to trade those events for the most part. But since the Forex market is open 24 hours and it's open around the clock, then it's going to be open for virtually any type of economic indicator that's released, not just in the country in which you reside, but in other countries around the world as well. So there are going to be a lot of opportunities there. Again, it is open 24 hours a day during the work week. The market, the market makers do generally close down over the weekend, but Monday through Friday, it's a 24-hour market. Also, I want to tell you that you have the ability to trade in the same manner, in the same fashion that a hedge fund trades. And what I mean by that, hedge funds have been in this market for many, many years, much longer than it's been available for individual traders like you and me. And hedge fund strategies such as interest rate arbitrage, they've been using these type of techniques for years and years, and that's something that you can do now as well. And we're actually going to get into that a little bit as we go on today. So let's take a look at our first strategy. We want to talk first about a strategy that is going to be specific to one currency pair. This pair is going to be the Great Britain pound US dollar. Of course, the pound is also referred to as the cable or the sterling, but we're talking about the pound and the dollar here. And what we're looking at is an opening range breakout trade. When I say opening range breakout, I'm referring to the opening range at around the time of the London Open. Okay? So we're talking about a specific currency pair, and we're talking about a specific time of day. What we're trying to do, we're going to attempt to capture the first major directional move of the London trading day. So let's take a look at how we would set this trade up. For long trades, right? First of all, pound US dollar, we needed to make a new range high at least 15 pips above the opening price, and then drop to make a new opening range low at least 15 pips below the opening price. What's happening here is orders are being cleaned up. The price moves up and then back down to clean up orders that are just, that are sitting around at the open. Why does this happen? Well, a lot of these orders are placed through these same big banks and that are actually, major players, interbank players in the market. They have a little bit of intelligence about this. They know that the orders are located. At least they have a good idea about it. And these orders can act as a magnet. So it pulls the price up or it pulls the price down. And once that's occurred and those orders are cleaned up, the market is free to make its first real directional move of the day. So once we've had it where, once we've established that opening range, the pair should reverse again and break above the opening range high. When it breaks out above that high and it's at least 7 pips above that opening range London high, we're going to enter a long trade and we're going to place our stop no more than 40 pips below our entry price. And we're going to take a look at a chart here and see exactly what this looks like on the chart. You can see here that the price makes its opening range high and its opening range low. And then it's going to break out above its opening range high. And obviously, in this particular case, it's going to work out quite well. You're going to see that there are a lot of different opportunities for these type of trades at the London Open. The London Open is a time where there are really a tremendous amount of opportunity involved for breakout trades. It's because London is the biggest, the most important market in Forex. So let's take a look at how we might want to do this in terms of a short sale type trade. Okay, so we're going to take a look at a short setup now, same type of trade. Again, we're looking for this pair to trade at least 15 pips below the opening price, and then reverse and trade 15 pips or more above the opening price. And what should happen then, the price again reverses, and it's going to trade below this intraday low. So we establish first the intraday range, then we break out of the range. This time we're breaking out to the downside. We're going to sell short. When the price breaks at least 7 pips below the London low, we're going to place a stop no more than 40 pips above our entry price. And here's another chart. Just take